Welcome to a special edition of the 3Edge Week in Review. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge Asset Management. Obviously, this week has been overwhelmed by Russia's invasion of Ukraine, which has once again brought war to Europe. And therefore, in today's video, I'll provide a brief update on the current geopolitical crisis and discuss some of the potential economic and market implications, as well as our current positioning. First, though, on behalf of everyone here at 3Edge, we send our heartfelt prayers to the people of Ukraine. And although I'm going to discuss this situation from an economic and a market standpoint, the human tragedy of Russia's invasion of Ukraine is undeniable and very sad. As we know, last Thursday night, Russia launched a full-scale invasion of Ukraine. And although Putin's endgame is uncertain, the scale of the invasion goes well beyond the separatist regions of eastern Ukraine, evidenced by the fact that at this moment, the battle for Kiev is underway, indicating that Putin seems to be seeking to topple the government in Ukraine. As there will be no military response from the US or from NATO, the Allied response to Russia has come in the form of economic sanctions. The US and its European allies appear to be united in their response to this Russian aggression, but it will take time for the sanctions to work. In terms of the economic and market implications of the Russian invasion, it makes sense to look at these in terms of first-order and second-order effects. One first-order effect of the Russian invasion of Ukraine can be seen in increases in commodity prices, particularly in food and energy. An immediate spike in agricultural commodity prices in response to Russia's invasion makes sense, since over 30% of global wheat production is supplied by Ukraine. In addition, the crisis in Ukraine brings additional uncertainty to the energy market, where the price of oil recently rose to over $100 per barrel. Taken together, increases in commodity prices could stoke already problematic levels of inflationary pressures in the global economy. It's also safe to assume that equity market volatility, which in the near term was already elevated with the VIX above 30, will continue. We witnessed firsthand this volatility brought on by the crisis in Ukraine on Thursday, when the markets opened sharply lower, but then rebounded late in the session. The bounce back in equities on Thursday afternoon wasn't necessarily all that surprising, since rebounds often occur following periods of panic selling like we had on Thursday. The question is, will the bounce back be temporary or sustainable? This conflict is far from over, and geopolitical uncertainty could be a cloud over the equity markets for the foreseeable future. However, it may actually be that the second-order effects of Russia's invasion will have the greatest impact on the global capital markets. And the severity of these effects may well be also a function of just how long the crisis in Ukraine drags on. These second-order effects include the impact that the crisis could have on inflation, on global economic growth, and on Fed policy, all of which, of course, are interconnected. The situation in Ukraine could serve to exacerbate already high levels of inflationary pressure in the global economy, including increases in energy and food prices that I mentioned earlier. In addition, inflationary pressure from the situation in Ukraine are more supply-driven, and there isn't a great deal that the Fed or any other central bank can do about supply-driven inflation. It's also likely that the Ukraine crisis will have a negative medium-term impact on global economic growth as more supply chain disruptions occur. Rising oil prices could also certainly negatively impact economic growth, inflation, and corporate earnings. With Russia's invasion of Ukraine, the Fed's path to normalizing, i.e. tightening, monetary policy to rein in rising inflation may have become more complicated with the situation in Ukraine. To date, the Fed's response to inflation has been quite slow and measured. And now, with the geopolitical situation in Ukraine, the Fed may need to be even more concerned about the impact that rate hikes could have on the real economy as they seek to bring down inflationary pressures, which could now be further exacerbated by the situation in Ukraine. However, even though investors may hope that the invasion of Ukraine will force the Fed to be more dovish in their approach to monetary policy and monetary tightening, we believe that the threat of mounting inflation is acute enough to overwhelm geopolitical factors that might impact Fed policy. In the end, regardless of developments in Ukraine, the markets will be heavily influenced by changes in Fed policy, but it is unclear if Fed policy will be overly influenced by the crisis in Ukraine. Perhaps the biggest risk from the Ukraine crisis is the increased risk of stagflation. Historically, sharp increases in energy have been stagflationary, meaning that inflation rises while growth slows, placing the Fed between a rock and a hard place and having to choose between fighting inflation or supporting the global economy. Not a great choice. In terms of the positioning of the core three edge strategies, based on our model research and prior to the crisis in Ukraine, our equity allocations have been well below benchmarks, and this has proved to be helpful as markets have fallen year to date. Our current positions in real assets, both commodities and gold, have also already performed well this year in the face of rising inflation and could benefit further from continuing inflationary pressure and geopolitical uncertainty. In terms of fixed income, we hold some amount of U.S. Treasury securities, including floating rate treasuries and TIPS, Treasury inflation protected securities. Treasuries are an attractive holding for situations like the crisis in Ukraine, which can trigger investors to a flight to safe haven assets. In conclusion, as we said in our recent note to clients, geopolitical uncertainty has always been a risk that we take very seriously and seek to hedge against. We'll continue to monitor events in Ukraine and their potential impact on the global capital markets, and we will not hesitate to take action if necessary. And so that will do it for this special edition of the Three Edge Week in Review. Steve Cucchiaro and I will be back next week with our regular Three Edge Week in Review video. Remember, all our videos are always available on our Three Edge YouTube channel, and our Three Edge videos and written commentaries are always available on our website at 3edgeam.com. So until next time, and on behalf of everyone here at Three Edge, thanks for listening.